With housing and rental prices having surged so much in the last 20 years, I've often run into clients or friends contemplating the usual three options when it comes to housing. Should I be renting, buying, or purchasing an investment property first and then maybe stay living with my parents and then later on move into it? Now, there are millions of articles or videos online already trying to break down especially the buying versus renting. I am still going to make one more video on top, but from a financial planner's perspective, and what I want to focus on are when is a good time to math out which is the best outcome and when math is actually not applicable and we shouldn't focus too much on it. These are going to be based on my experience when it comes to planning with clients, seeing maybe the outcome over several years or longer, and also my own experience from a renter being a homeowner and also have invested in properties before. Alright, without further ado, let's dive into this week's video. Now I'm going to break this video into two parts. The first one will be renting versus buying, and the second one will be just solely on buying a property as an investment. I'm separating them because renting versus buying is a unique category, I believe, which is more talked about, and it's also more detrimental to someone's financial plan. Now I don't mean detrimental as in someone is going to make a wrong choice and end up losing money. In fact, I believe it's complete opposite here, which is why I'm separating them. I believe if we're looking at the money side, the only calculation you should ever do when it comes to renting versus buying is the cash flow for each and see which one is more suitable to your lifestyle. Any other calculation, especially the long-term projections to see which one is going to net us more in the long run, I believe it's completely pointless. I see so many people that have overly focused on this long-run projection calculation that they end up paralyzed with choices and they either do nothing or they make a decision and they immediately regret that. Now, why do I say from a financial perspective, long-run calculation actually is pointless? Let's go through an illustration example together. So what I have here is a fully automated worksheet that I have built originally for investment properties calculation, which we will be going through in the second part on the video. Now, what I've done is actually modify the chart to compare every year's ending net worth when it comes to renting versus buying. And the whole chart updates automatically as soon as we change one variable. And here we'll be using a real example of a one-bedroom rental at 2311 Beta Street for $2,600 online, that's what it's listed for, versus another unit that was on sale for $589,000. Now this chart is quite simple. It lists out a bunch of assumptions such as inflation, rental growth, property value growth, mortgage info, etc. And we're also going to list out all the costs associated with the purchase, such as down payment, property transfer tax, and our upkeep going forward. The chart then automatically scales up the numbers according to assumptions we set. For example, property tax, insurance, etc. here will be scaling up depending on the inflation percentage we've set. It will also list out net equity we get back on our hand if we sell it at any given year. And we can compare that to the rental side. Here we take the difference between rent and housing upkeep plus the total lump sum we didn't have to commit since we're renting and investing all that into the market. Now every year we add more to it if the housing upkeep is higher than rent, or we take away if the rent is higher than the upkeep. Assuming an average growth rate, we then can compare the total investment account value before tax to the net equity from selling each year. Now tax here I think is less important if you're doing condo or maybe even townhome, because you could stick all that down pay into a TFSA, especially if you have two people buying it. And so you can pretty much skip all the taxes. Now, if you look at this graph on the side that we plotted, you're going to realize this looks awfully a lot like all the other online calculators or videos out there trying to math out which one is the best in the long run. I also want to start here because I actually have a lot of issue with such calculation. First of all, I'll tell you this right now. If we do a straight line calculations, especially in Vancouver or Toronto, buying is always going to beat renting 10 out of 10 times. But does that mean buying is always better than rent in real life? Well, not really. An issue, first of all, is that the upkeep cost is too unrealistic or conservative if you just assign a small inflation number to it every year. Now take strata or insurance for example. If you have ever owned a condo especially, you know that these two numbers do not go up a small amount every year. They go up quite a bit, and some years they can go up massively. Now take my last home for example. When we moved in, it was already about 15 years old, so we stayed there for about 5 years. After second year of living there, our strata actually got revised upward for 70% the next month. Now the reason is simply because the fund reserve is running too low and they revised it, and in order to catch up, everybody has to start paying a lot more. Not only that, my strata insurance also almost doubled year 3 because my strata insurance deductible went from 100k to 250k next year. And because of that, I have to get a much bigger strata insurance personally to cover myself. Now, if we apply this to this example where strata went up 70% and then insurance went up double the next year, you can see the graph does shift immediately if they are getting closer together. At this moment, buying is still better than renting in the long run. However, we're not done yet. Another thing to consider is lump sum spending. As a homeowner, we are expected to, from time to time, to spend a good chunk of money on various different things. So for example, for us, like I said, because last home is a bit older, 3 years in with this small rental costed us about 15,000. And then for us, at year 5, when the building was 20 years old already, we got hit with a pretty major special levy. So the exterior wall needs a pretty substantial repaint and fixes because it was cracking. The whole thing, they said, is going to cost like 2 million or 3 million, which translates to about $10,000 per unit. Now, you may argue that, well, if I'm new condo, then that should be a lot better. Well, not actually, because right after I moved to a brand new building, and as soon as I moved in, the AC started having issue and it was actually broken beyond repair. Now, there is some legal issue between the strata and the developer to see who's covering it. But if they're not covering it, the insurance is not covering it, then it's going to cost about 300,000 to fix the whole thing, which I think every unit has to chip in a couple $1,000 right away. So yeah, home ownership can cost you quite a bit, especially if you're unlucky like me, brand new building, you still need to fix something. So if we apply this kind of random fixes, let's say here and there, to the example we just have, you see immediately the graph adjusts and now it's much closer to each other. And also finally, there's one big variable we didn't really adjust, and that's the rate of return on average. So 6% is something I've used because that might be a balanced investor. But if you're someone super aggressive or you just run into a bull market again like the last 20 years, you could have a much higher return than the 6%. Even a small adjustment from 6 to 6.5 immediately shift the curve, and they're basically stacked on top each other. Now, one other element to consider is also property price and how much it's growing. I know the last 20 years house prices went up, 4x. If we were to go through this same scenario again, then no doubt buying is going to be a lot better than renting. However, like with investment, past performance doesn't indicate future performances, so we have no idea how much it can grow. We can also have a very stagnant next 20 years where house prices do not move at all. If that were to happen, you will see that immediately renting is a lot better than buying. So by now here, you can probably tell why such calculation in the long run is a little bit pointless, because we can do all the projections we want, but when it comes to real life, it's a lot messier than a straight line calculation. And depending on which variable gets changed and how drastically the changes, the outcome can be completely different. So instead, when it comes to buying and renting, this is why the only math you should be doing is cash flow. What cash flow are you going to face for both, and which one fits your lifestyle more? Other than that, the only thing we should be considering is other intangible characteristics of both, the pros and cons basically. And here I'm not going to talk too much about it because there are millions of articles out there already. I believe at the end of the day, it just comes down to, do you value the stability and the conservative leverage concept of home ownership in exchange for more surprises spending on the side? Or do you want something that's like renting is very unstable, you get rent evicted, but you can use that lump sum and potentially, if you're aggressive enough, if you're good enough in investing, or if you're lucky enough, generate a huge amount of return. For example, you could dump all that money into Nvidia and make hundreds of percentage of return within 1 year. Which one do you value more? And my advice here is to think it through, decide quickly, and then make a plan around whichever lifestyle you have chosen. Now, the most detrimental thing I see people do regarding this topic is actually not doing anything. They're stuck in limbo, like I was saying, trying to map out which one is the best for them in 30 or 50 years. And during this time, they're leaving that down payment in their saving account, not investing it, missing a lot of opportunity cost. Or they are not utilizing the correct accounts like FHSA or RSP for their home buyer plan, and they're missing out a lot of tax refunds that they could have reinvested for further compounding. Now, before we move on, finally on the topic of, well, I want to buy, but should I be waiting for the housing market to cool down a little bit more so that I can get a better entry? This one I absolutely don't agree. It's the same saying, time in market is better than timing the market. Yes, you may get a better entrance maybe 6 months from now. However, if you're self-used and you're staying in that home for 5 years or more, I believe in the long run, it's all going to even out each other. And if you always have the mindset of maybe the price will drop, I can get a better entrance, if the price does drop, you wouldn't commit anyway because you will still be thinking, the next 6 months it could drop even lower, so maybe I should wait. So again, you're stuck in a limbo unless you need that price to drop a little bit just so you can actually buy the property, or you can't even do it in the first place. Then you have no choice but to wait. But other than that, as long as your cash flow has been calculated, you're okay with it, your down payment and your mortgage is all ready, you should start looking, and as soon as you find one, just make an offer. Alright, so basically from financial perspective or long-term view, renting is fine, buying is okay, but indecision, getting stuck in the middle, trying to math this out is not good, and also it will cost you a lot, and it's pretty much pointless to do so because you can never guess which one is the best. However, when it comes to investing in a property to generate rental, this is something you can math out. You should math out short term all the way to long term, just so you can decide if this is the best opportunity for you. So let's go through this together. Alright, so let's go through the same worksheet together, but this is the original version I made for rental properties. Now here I'm going to go through a pretty quick overview. I'm not going to go in depth. I don't want this video to be too long. If you're interested in rental properties specifically, let me know in the comment. I can make another video just on this topic. Okay, so here it's the same thing, but we're calculating 3 metrics: cap rate, cash on cash yield, and internal rate of return at sale. Now, there are actually calculators online. I'll link them below. So if you just want to use them yourself, you can check out these links. Now, I've built mine from ground up to be a lot more customizable. I can change any numbers at any given year, not just a straight line calculation. So it gives more flexibility to discuss with my clients on different metrics calculation using their real properties as data for discussion. So here are the 3 metrics that we usually want to at least look at are starting with cap rate. Basically, this is how much percentage return the building can generate by itself. So here we're looking at net operating income divided by current property value. Now we're ignoring mortgage here and also taxes, because different people have different mortgage setup and also different tax rate. So we don't care about those variables. We just want to know the building by itself, how much income it can generate. Now this number actually doesn't mean much. We have to compare it to another building. The higher the better. So first of all, if you have multiple deals you might want to put money towards, then you want to at least know the cap rate for each to tell you the performances of this building net of taxes and mortgage. Now, the next one you want to calculate is actually cash on cash yield. This is different from cap rate because it focuses on how much return does the net rent give you versus the equity you have put inside this building. Here we do include mortgage. Now we can use this again to compare this across different deals to see the performances. But another use for this is we can actually preset a cash on cash return that we're looking for, and then we can play around with the numbers, especially the loan to value ratio, to find the most optimal debt setup. Now lastly, this calculation helps show us the expense profile of this property. If our cash on cash return is too low, it might be a sign to start reviewing all the expenses to improve the efficiency or to save cost. And then finally, another number that we can also calculate is internal rate of return at sale. So what this is actually give you an idea that if the property were to grow to a certain value, how much return it's going to actually give us per year. This also takes into account the net positive or negative cash flow we've been receiving from this property prior to sale. So for example, if we're selling at year 8, then it's going to take the net sale value. For us here is going to be before tax, but we can also apply it after tax value, all the cash flow we have been receiving prior to that. Now again, we can use this to compare to other investment property or even other investment instruments or projects and then see which IRR is better versus the risk that we may be taking on. However, most people actually stop at IRR, and I want to illustrate here that it's not actually the most accurate calculation, because the problem with IRR is that they assume all the positive cash flow you have received every year, you are reinvesting that into the same property to give you the same return, which most likely is not true. You might actually take that cash flow and do something else with it. So to be more fair to that reinvestment opportunity, we can actually do something else called the modified internal rate of return. So a MIRR takes into account the rents that you have gotten all these years, which you may not be reinvesting in the same property. Most times, we actually tend to put them into a saving account, or we do GIC. And because of that, we're now going to actually look at two rates. The first one is the WACC, the weighted average cost of capital. This is how much interest rate we are likely paying overall to buy this property. However, it is not just the mortgage interest rate we're looking at. We also have to factor in the equity rate, which is if we were to reinvest the down payment somewhere else, what is the rate of return we can expect using similar risk? So for example, let's say in here, we're assuming 10%. Okay, so if I don't put my down payment towards this property originally, I could have invested that in somewhere else and I would expect 10% return from it every year. Mortgage rate right now is 7%. So proportionally, the WACC, it's going to be 7.6%. This is basically the percentage cost we take on by dumping the down payment and borrowing mortgage to buy this property at this time. Now, the second number we have to assume is a reinvestment rate, which if I use cash or GIC to assume right now, the risk-free rate should be about 4%. So when we enter that into the Excel, we can get the MIRR, which will be readjusted downward to reflect a more realistic return on our investment. So with these three metrics, we can now then math out the opportunity cost versus other projects or other properties. So for example, this one is in US. This is the one that my client is purchasing. We can see all these actually looks pretty good, especially if you compare to something like Vancouver. So if I compare that to 2311 Beta 3, you can see even just year one, it doesn't stand up because Vancouver is way too expensive. Whereas in the US, this property has been doing Airbnb very consistently for many years. So their rental income is a lot higher. Now, one last tip I'll recommend here is to include vacancy. We can see even using the US property, just a 5% vacancy rate will completely change the metrics, even change the ones from positive percentage to negative pretty quickly. And this is something I see a lot of clients go through. They just assume their rental property will rent out 365 days. They've never considered vacancy. And when you put that in, they think, 5% vacancy or even 10% is pretty low, like who cares? It actually means a lot in the long run. So pay attention to that. For rental properties, this is where I think you should math out everything in very detail and then make the best choice possible, and also revisit all those numbers every year to see if this is still a property you want to hold on to it, or maybe if the sale price is specifically higher that year, if the IRR looks really good, maybe you want to let go of that property and then seek opportunity elsewhere. All right, so that's basically it. I want to illustrate today why buying versus renting is pointless trying to math out the best outcome, and why when you're investing in rental properties, this is where you should math out in very, very detail every year. Now, if you have any questions regarding this, or you agree or don't agree with something, let me know in the comment down below. Other than that, if you like these kind of videos, I do upload them every 2 weeks. I know I was a little bit late on this one, but I do try to keep it every 2 weeks. So make sure you subscribe to the channel, click the bell button so you get all the notifications in the future. Alright, this is Jacky. I hope you found this interesting. I'll see you in 2 weeks. Bye!